topic 2, we want to cover some stock pricing basics. And so the objectives for this unit are to be able to differentiate between price and value, to be able to define fair valuation, to understand the logic of valuation, and to use that logic to actually come up with an estimate of price to do a valuation, and then to utilize those estimates that we work on to actually make investment decisions. So we're going to start at a very basic level here and build up. And I like to start off with the wisdom of Warren Buffett on this issue of price versus value. And he says, price is what you pay and value is what you get. And the stock price is the price that the market is currently charging for a share of stock. And so this is very easy to observe. Publicly traded companies, we can watch stock price changes in real time. We can watch while the market is open, these prices change. We know the price that we are charged. But just looking at price by itself is not very useful information. We really need something to compare it to help us make investment decisions. And so that's really where value comes in. And if you just stick to like a dictionary definition of value, it means what something's worth, an estimate of what something is worth. Okay, so that's really no different in the context of stocks. What is the stock worth? We know what the price is, but what's the value? What's it worth is another question. And so as we start to think through this, it's helpful to remember that as investors, we expect a certain amount of return. The reason that we're willing to put our money into a stock is because we expect to get money back. And so the way that we determine value is really by establishing what's the price that we could pay and still get the return that we want as investors. And I like that the dictionary definition of value includes the term estimate of worth, because we don't really know exactly what the value is, but we can come up with an idea of what might be a price that we'd be willing to pay, a value that made sense to us. So it's useful to take just a step back, I think, a little bit and look at how investors get that return that they desire. Well, in stocks, dividends, and capital gains. So regular dividend payments and being able to sell a stock for more than you bought it for, a capital gain. That's the way that you're going to get your return. But in both cases, that's really cash coming back to the investor. So you put in a certain amount of cash to buy the stock, and you hope that you get that cash back and then some. That's the return that you're looking for. But that comes in the form of cash, just to be really specific about it. And because investors measure their success by the cash they receive, it makes sense to think about businesses in the same way. How do you decide whether or not a business makes sense to invest in? Well, think about business value as being driven by the cash they create. As the business creates cash, it increases the chances that you as the investor are going to receive that cash either through dividends or through capital gains. So we know that the driver of value is cash because that's our value as an investor. That's what makes a stock worth something, is the ability to get cash back. So really, the main thing that we need to do as an investor is come up with an estimate of value which we can compare to price, and then we want to see if we're getting a good deal or not. Ultimately, we'd like a fair deal, maybe even a better than fair deal, a bargain, but we need to be able to come up with a way of getting our own idea of what something is worth so that we can compare it to the price that is easy to observe that the market's charging us. And then we can decide if we want to pay that price or not, see if it makes sense to do that. So when we get into the concept of fair valuation, it's just really important to note that we do not know the exact value of a stock. We can only estimate the value of a stock. We know the price of a stock. We know that precisely, but we do not know the value precisely. So fair value is something like our best guess at the true worth or the true value of a stock. Fair valuation is really the price that you can pay to get exactly the desired rate of return that you want, right? This is the price that you would pay and say, I feel very confident I'm going to get the return that I want out of this stock. It's an alternative to market price. and market value. So market value is determined by supply and demand and the trading activity of the day. And that's an important piece of information, but this idea of fair value is separate from that. And again, it is estimated, it is not known. So with respect to the logic underlying valuation, there are really two general approaches or views, you might call them. The first is that market price and value really are the same thing. I've been saying you've got price and you've got value, and they're not necessarily the same thing, but some people take the view that the market sets the correct price, that the market identifies value and price. And so that's one way of looking at it, that market price is equal to value. The alternative approach that's more consistent with the way that Warren Buffett approaches investing is that the market price may or may not equal the value. We can't take it for granted that the market price equals the value. I want to spend just a second talking about this idea that the market price equals value. Even though many investors like Warren Buffett do not think this is true, let's just be clear about what that logic says. If you follow that through to its conclusion, then you would realize that there are no bargains. If market price and value are the same, there are no deals, and there are no overpriced stocks. Okay? So if that's the way that you think the market prices work, if you think they reflect true value in all cases, then you're in a world of no bargains and no overpriced stocks. But even in that world, you would still need to understand how those prices are determined, right? Because you would still want to have some idea about the future price, even if you think it's going to be the right price or the fair price, and then the market price is always going to be right. You still need some sense of how that might move forward. And to do that, you still need valuation logic. I'd also point out that if you think that the market price and value are the same thing, then any analysis you would do on a stock is really just about justifying the value that you see. And Chuck likes to say that fast graphs doesn't justify value, it reveals it. And so this is getting at the idea of it can be a bit of a dangerous game to try to justify market prices. It can be unhelpful and cause you to either avoid potential bargains that would be good or not to avoid overpriced stocks that could end up causing some pain as an investor. So there's danger potentially in assuming that market price and value are the same thing. So an alternative approach to that is to have a rational and independent estimate of value that you use to compare to the prevailing price and then make your own decision about whether or not that's a fair price. In other words, instead of just taking the market's word for it that it's set the fair price, you want to do your own analysis and think for yourself and come up with your own idea of whether or not that really represents a fair price from your perspective. And so that's really the logic of what we're trying to achieve with valuation. And what we know from history is that in the long term, prices correlate with earnings or cash flow generation. That at the individual stock level and at the market level, over the long term, that there is a strong link between the ability to generate cash and prices. So we can use that information to really help us with a process to estimate value. And we start with this idea that value is driven by cash generation. And why is that important? Because we know in the long run, prices will reflect cash creation. And so value needs to be based on cash creation. We can estimate future cash generation and then establish what that future cash is going to be worth today, in today's dollars, as we look at things now. What are we willing to pay for this future stream of cash flows? That's the logic of what we're trying to achieve here. So the main crux of valuation, though, is to actually generate an estimate of price that helps us make decisions. And so that's the result of valuation, is an estimate of price to be compared to the actual price. And it's really best to think about valuation as a range. So this is a range, an approximate. This is a game of pretty close, right? This is a game of somewhere in this area, somewhere in this region, we think the true worth, the true value lies. But we don't want to get overly focused on a precise single number. And that's important to realize because as we do some of the calculations, you'll get precise estimates of value. But it's just really important to realize that's one estimate of value. We want to look at it in a variety of different ways and get a range of values. It's more helpful to look at valuation that way. Well, one way to estimate price, to do a valuation, is to combine an estimate of earnings and a reference price to earnings ratio. And that's what we're going to do in topic 2. And so here we're just focused on keeping things pretty basic. There are other multiples you can use and other approaches to valuation. We're just going to pick one to just show how valuation actually works. And so the way that we're going to do this is going to utilize earnings. And earnings are pretty handy because that's pretty widely available information for publicly traded firms. Analysts generate estimates that look forward, what a firm is going to earn, and financial reporting tells you how much a firm has earned over a given period. And you'll see both of these identification tactics for earnings used. So you'll see some folks that will base value off of forward-looking earnings, and you will see some estimates of value that are based off of historical earnings, earnings that have already been achieved by a firm. So the way that we're going to combine some way of identifying earnings and get that to a price is to combine it with a price to earnings ratio. And a price to earnings ratio is very simple, and it's exactly what it sounds like. It just takes the price per share and divides by the earnings per share. So you can think of the price to earnings ratio, the PE ratio, as the charge for $1 of earnings per share. That's what the market is charging you for $1 of earnings per share. Okay, so once we have an estimate of future earnings or an estimate of earnings at all, and a reference price to earnings ratio, estimating value is very simple. All we need is to multiply the estimate of earnings per share by a reference price to earnings multiple. And what I mean by a reference price to earnings multiple means what's a fair multiple? What's a fair charge for that dollar of earnings per share? And we'll talk more about how that reference is established. But for now, we're just going to kind of work off of the way that FastGraphs approaches this for typical or average firms. They use a PE reference of 15. And I'm sure you're wondering why 15, and we're going to dig into that in great detail later on. But for now, that is the range that FastGraphs uses. That's a range that makes sense for a lot of firms in normal situations that have kind of traditional operating structures. And so this means that the value of $1 of earnings per share is worth about $15. And it's a pretty simple statement. It's just a product of the ratio, but it's a pretty powerful statement because it allows us to use that information to come up with an estimate of what something's really worth. If we think $1 of earnings per share is worth about $15, we can use that to come up with an idea of what any stock might be worth. So let's just do an example to actually estimate a price. Let's say some firm ABC has earnings per share of $4. And let's assume we're going to use this reference price to earning, this reference PE of 15. Okay? Then to estimate price is very simple. You take the earnings per share, $4, and you multiply by the reference PE of 15. So 4 times 15, or $60. So that $60 is one estimate of price. That's one valuation. This is one approach of doing it for this particular example. Let's look at a second example. Let's say firm XYZ has earnings per share of $10. Well, let's assume that same reference PE of 15, and let's estimate price. Let's value this firm by taking that $10 per share and multiplying by the reference multiple of 15 to get $150. So the actual valuation or calculation of the price estimate is incredibly simple and straightforward. And it's all based off of the logic that the value of a firm is based on the earnings that it generates. And so this just takes the earnings that a firm generates and then applies a multiple to come up with what those earnings are worth. Okay, so then when we take our valuations, our estimates of price to make investment decisions, it's pretty straightforward. We're just going to compare our estimate of price to actual price or the market price. We're going to compare our independent valuation to the market's pricing or valuation. And the logic is, in how you translate this to a decision is pretty straightforward. We want a fair deal or better. And so that's what we're looking at. Is the market offering a fair deal right now or not? So let's look at some example of some market data here. Let's go back to this first example of firm ABC that's got $4 of earnings per share. We generated an estimate of price of $60. Well, what if the market price is currently $70? Is this a good deal? Well, this means the market is charging you $70 for something that you estimate to be worth $60. So the market is charging you more than you think it's worth. You probably don't like this deal. There's, of course, a lot of other factors that could go into whether or not this was an attractive investment. But for now and for this example, it's pretty clear that this is not a good deal. We have come up with an estimate, a valuation, that says $60 is fair. The market wants to charge us $70. We don't have to take that deal. We can simply not buy this stock. We don't have to take an unfair deal. No problem. We'll pass on this one. Let's look at example 2 of XYZ. They have earnings per share of $10, and we use that to come up with an estimate of price, a valuation of $150. Well, what if the market price is $130? Is that a good deal? Well, in this case, the market is charging us $130 for something that we think is worth $150. This is a bargain. This is a good deal. This is a value buy. This is something selling for less than we think it's really worth. The price that we pay is $130. What we think we get back in return is worth $150. We would like this deal just based purely off of price in the simple valuation exercise. Well, the same approach, the same logic applies to estimates of future price. So if you want to think about where might the stock price go in the future, then we can use the exact same logic. And here we need an estimate of future earnings. And then everything else is exactly the same. We multiply by the reference price to earnings ratio. So let's take an example of that. So let's go back to firm ABC. Let's say that $4 earnings per share we looked at before was what they have realized. That's historical. It's looking backward. But now we want to look forward. And let's say that firm ABC is expected to have $5 earnings per share 1 year from now. Okay? Well, let's assume that the reference price to earnings ratio is still this 15. So we can estimate price, the valuation, by taking that 5 and multiplying it by 15, and we get $75. Well, it's important to realize what this estimate is. That's saying in 1 year, when we think this firm is going to generate $5 of earnings per share, we would expect a reasonable estimate of the price to be about $75. Well, if the current price of the stock is trading at $60, is that a good deal? Well, it's a little less clear when we start thinking into the future because it depends on the return that you want. But if you are good with paying $60 for something now and having it be worth $75 a year from now, then it's a good deal. If you're not okay with that deal, if you need to get a better return than that, then maybe you don't take this deal. And maybe your answer would change if the current price was $70. Would you buy something for $70 today that's going to be worth $75 potentially in a year? That depends on the return that you want. Or what if it was trading for $75 today? So you could buy it for $75 today, it's worth $75 in a year. Is that a good deal? This is where your preference and your goals and your required return and a lot of other factors like the risk of the firm. How sure are you of that earnings estimate? Is that really the right reference multiple? This is where a lot of the nuance and complication can come in and help us make decisions. But at just the basic level, the stock pricing basics that we're covering here in topic 2 really says use some method to establish your estimate of fair value to help you make decisions. It's a tool to help you make decisions. And so a recap of what we were trying to establish here in topic 2 is that we wanted to be able to differentiate between price and value. So we wanted to be able to say price is what you pay, value is what you get. And so how do we define fair value? What does that mean? Well, that means the price that you would be willing to pay and still expect to get the return that you require. And then we talked about the logic of valuation. We talked about value is driven by cash flow generation, by earnings. And how can we use that to come up with an estimate of value? Well, we used that to come up with an estimate of value. We took estimated earnings and combined it with a price to earnings ratio to come up with an estimate of price, a valuation. And then we compared our estimate of price to the market price to help us make decisions. So this is the very basics of using value and valuation to help us make decisions as investors.
Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs. I want to thank Professor Nathan Mock for that excellent presentation on stock pricing basics, topic 2 of our workbook here at the Value U Academy. And what he did was he really provided us some really great insights into the difference between price and value. And I think that's critically important, and I think he did an awesome job. But here's the key. Investment theory is fine, and it's all great. But at the end of the day, it has to work in the real world. And one of the things we're going to do here in this second part of the video is show you some real-world examples of how the concepts of price and value, especially the PE ratio equal to 15, really applies and works in the real world. So let's go ahead and get into it with some good examples. I'm going to start here, and I'm going to introduce you to the FastGraphs research tool a little bit, since many of you are new to it. Many of you have been subscribers for a long time, but many of you are new to it. What Professor Mock was telling us is, price is what you pay, value is what you get. And what we're trying to do is create an estimate of value. So what FastGraphs does is we apply what we call valuation reference lines. That's this orange line on the graph. And we're going to focus in this video only on operating earnings, which was primarily what Professor Mock talked about in his introductory remarks. I do want you to be aware that there are a lot of other metrics, including several cash flow metrics and sales metrics that we'll be able to value stocks with. But this is the introductory portion of the Academy series here on price and value. All right, now, the key is that this is a valuation reference line. Now, the reason I use those words, valuation reference line, is because we're applying the 15 PE ratio that Professor Mock talked about, because it applies to most companies. But it really applies to companies that grow at average rates, and it even applies to companies that grow at very low rates. When you start getting into higher growth, we'll be covering that in topic number 3, where we talk about exceptions to the rule. But the general rule is a PE ratio of 15 turns out to be a good proxy for valuation. We're going to leave it at that for this particular portion of the Academy curriculum here. So what we've done is we've drawn an orange line on this graph by multiplying each year's earnings, and I'm using AmerisourceBergen Corporation here, and we're looking at each year's earnings, and this company has a fiscal year of September. I want you to note that. We're multiplying each year's earnings by 15, and then we're drawing a dot. Okay, and then that dot would represent a valuation reference. That's a 15 PE ratio. Now remember, Professor Mock talked about the idea that this was a range. So you should think of this as a little bit above and a little bit below. Anywhere a little bit above and a little bit below would theoretically be a good estimate of fair value, because as he also pointed out, valuation is an estimate. Okay, but valuation is a function of the amount of, as he said in his slide, the cash that the investor receives. You measure that by how much cash you're getting, and that's what this valuation reference line is depicting for you. It's showing you how much cash you're getting, but we're using the metric earnings. Okay, so we're estimating value by drawing the PE or multiplying each year's earnings by 15. This line then represents our estimate of the fair value, and you can use words like intrinsic value, true worth value. There's a lot of different words that people use to describe this, but the reasonable value of this business, what the worth of the business, as Professor Mock called it, what's the business actually worth? Now, again, it's an estimate, but it represents a best guess of the true worth. So now we've done that. Now the question is, what happens in the real world? Now the way to do that is that you would check this by simply correlating price to that valuation reference to see if in the real world that the market price and the value actually correlate, actually work together. So I'm going to add weekly closing stock prices onto this graph going back to 2001, which is the black line here. And what you notice very quickly is that the price very closely tracks this line. All right. The price goes where the earnings of the company goes, okay? But he also pointed out that market price, some people say the market price is the intrinsic value. Well, there is a difference between market price and intrinsic value. And this particular company illustrates that very nicely because we see a period here, in 2013 and 14, where the market price was significantly higher than our estimate of fair value, which is this orange line on the graph. All right. And you also see what ultimately happened. The price ended up reverting back to the intrinsic value, if you will. But we also saw that with undervaluation. Okay, so, market price is not really necessarily value. And like Professor Mock said, if it was, there would never be a bargain. But a bargain would exist when you could buy the stock or find the stock trading at a valuation below the orange line, like you do here. And here you've got a PE ratio of 10.8. And you can see that resulted in some very nice long-term returns. If you come into the Great Recession here, you could have bought the, AmerisourceBergen at a PE of 9.99. And again, you can very quickly see that you ended up with almost a 19% rate of return, and the company wasn't growing quite that fast, but close. So the point is that that's what represents a bargain. All right. Again, if the market value was the fair value, then there would be no such thing as a bargain, and there would be, as Professor Mock taught us, there would be no such thing as overvaluation. But when you put it into this context, what FastGraphs does for you is really illustrate that very quickly and very succinctly for you, because market value and intrinsic value are not the same thing. Nevertheless, with this first example, you see that the 15 PE ratio that Professor Mock taught us and talked about is really extremely relevant. You can see how the price correlates to that. So let's go ahead and look at another example. Let's look at Amgen. Again, this gives us the opportunity to look at price and value. Now here we have a 12.6% grower. What's interesting is that if you go back to 2000, into 2000, beginning of 2001, you see that this stock was trading at a very, very high valuation. The PE ratio was over 70. And you can see that the earnings consistently grew. And once again, we have an orange line here that's a PE ratio of 15. So here we have that issue where you have overvaluation. Okay, and overvaluation becomes visibly evident to us here, and you can see that the stock price did nothing for a very long period of time here. It would literally resulted in a negative rate of return because of high valuation. Market value and intrinsic value are not the same thing. But then once the stock got reasonably valued, you can see that since coming out of the Great Recession, that Amgen's stock price tracked its 15 PE ratio very, very closely, but it also did it at a very high rate of growth. So let's shorten the time frame here where we're coming just out of the Great Recession. All right, we've got earnings growth here of about 9.3%. And I want you to note that the stock price, was attractive at about a 12.8 PE here. Currently trades right at that fair value 14.9 PE as of producing this video here. And you can see that the price followed that. And when it gets overvalued, it comes back. When it gets undervalued, it comes back. The key point here is the logic of this valuation shows, as Professor Mock taught us, that in the long term, prices correlate with earnings. Okay, so, value truly is driven by cash creation, but your rate of return is also a function of attractive valuation plus the fact, the growth that the company, goes ahead and achieves on your behalf. And that's the secret of valuation. It allows you to participate fully in the growth of the business. Now, this concept works just as well with cyclical stocks as it does stocks that had very smooth earnings growth, like we saw with Amgen and AmerisourceBergen. Here you've got a cyclical where, if I take the price off the graph, earnings rise and drop and rise and drop and rise and drop. Once again, we've got this 15 15 PE ratio drawn here. We're multiplying each year's earnings by a PE of 15. And in future installments, we'll be talking about the relevance of a 15 PE ratio even more. But for now, we're just simply giving you the real world proof that that 15 PE does have, in most cases, not all, because we're in part 3, we'll also talk about exceptions to this rule, but you'll see that there is a very tight correlation between a PE of 15 and the market price, as you see here with Caterpillar. Another example of a consistent grower would be CVS, and again, I'm using this to summarize what Professor Mock was teaching us. There are bargains created when you can find the price below the theoretical estimate of intrinsic value, and a stock is clearly overvalued when the price gives above that estimate of intrinsic value. But once again, you can see that the 15 PE ratio becomes kind of a clarion call, if you will, to the stock price, always saying, come to me, follow me, because it only makes sense. And we'll get into why that makes sense in a lot more detail later on in the curriculum. Now, going back to another cyclical Cummins here, the diesel manufacturer, you once again see this very strong correlation between market price and a 15 PE ratio. You've got actually some pretty robust growth here at 12.8%, and you've got performance that's going to correlate that very closely. I don't have any dividends on this graph, but you got about a 15% rate of return because you had undervaluation, a little overvaluation, but you also got dividend income. But I'm not talking about dividends at this point. We're strictly talking about the relevance of fair value being articulated by a PE ratio of 15. But most importantly, we're providing real-world evidence here that that relationship does have meaning. It does have profoundness. In other words, stock prices do track a company's earnings growth over time, and a 15 PE ratio turns out to be a very, very good proxy. Here we're looking at Federal Express Corporation, and once again, you see the 15 PE ratio, the orange line on the graph. You see the stock price. Following that, you see periods of overvaluation and occasionally periods of bargains. But generally, you see the price correlating to that 15 PE, which becomes a very strong proxy for value. But remember, this is a range, okay? There'll be times when the PE, would be slightly less than that, and there'll be times when the PE might be slightly above that. But in the long run, it becomes a very good benchmark, if you will, of fair value when you're evaluating stocks. All right, so that's the whole point of the message thus far. Now, I also wanted to end with a lower growth company. We're going to look at Southern Company here, the utility stock, with about 4 or 5% growth. And once again, you see the 15 PE ratio. You get some really interesting variations from that. You get overvaluation in bargains with Southern Company, but even for a slow growth company, the 15 PE ratio still applies. Okay, so it's not just the PE ratio itself, it's also, for as far as your return's going to be, it's going to be the PE ratio inconsistent with the growth rate that you're looking at. Faster growing companies will generate a better rate of return, but if you buy them at a true worth or a fair value PE ratio, you then participate fully, and you get to participate fully in the business over the long run. So what I've attempted to do here is just give you some real-world examples of what Professor Mock taught us under topic 2 here of our curriculum and our workbook. In the future, we're going to be covering additional metrics. We're going to be looking at cash flows, things like sales, EBITDA, EBIT, etc. And we're also going to be showing you some exceptions to this rule and why those exceptions occur. Because at the end of the day, fast graphs is a tool to think with. And the idea is, as Professor Mock pointed out in his part of the video, we're not dictating fair value here. We're attempting to reveal it and then give you, the user, the perspective of whether a stock is actually available within a reasonable range of that fair value or whether it's overvalued or undervalued. Anyway, it's been Chuck Carville saying thanks for watching. We look forward to this continuing Fast Graphs Value U Academy series here, where we're going to be covering investing. We're going to be covering principles of investing. We're going to get into financial statement analysis and a lot more. So stay tuned and certainly subscribe to our channel here and subscribe to the Value U Academy series, because I think you're going to find it very interesting and very beneficial. I really appreciate it. Give us a like and subscribe if you will. Thanks for watching.